What are futures? Futures are a subsidiary agreement to trade a resource sometime not too far off at a settled upon cost. That resource may be soybeans, espresso, oil, individual stocks, trade exchanged assets, digital forms of money, or a scope of others. Futures agreements can be utilized by numerous sorts of monetary players, including financial backers and examiners, as well as organizations that really need to take actual conveyance of the product or supply it. Oil, for instance, is aware that can be exchanged fates contracts. Financial backers can likewise exchange SP 500 fates contracts, an illustration of stock prospects money management. What is a prospects market? A futures market is a trade where financial backers can trade prospects contracts. In run-of-the-mill prospects contracts, one party consents to purchase a given amount of protections or a product and take conveyance on a specific date. The offering party to the agreement consents to give it. Find out more. What are the best where-ifs? Most members in the prospects markets are purchasers or business or institutional wares makers as per the product fates exchanging commission. Where fates and choices should be exchanged through a trade by individuals and firms enrolled with the CFTC. 1. To conclude whether prospects merit a spot in your venture portfolio, think about the accompanying. How do fates function? Prospects contracts permit players to get a particular cost and safeguard against the chance of wild cost swings up or down ahead. To outline how prospects work, think about stream fuel. A carrier organization needing to secure in-flight fuel costs to keep away from a startling increment could purchase a fates contract consenting to purchase a limited measure of fly fuel for conveyance in the future at a predefined cost. A fuel wholesaler might sell a futures agreement to guarantee it has a consistent market for fuel and to safeguard against a startling decrease in costs. The two sides settle on unambiguous terms to trade 1 million gallons of fuel, conveying it in 90 days at a cost of 3 per gallon. In this model, the two players are hedgers, genuine organizations that need to exchange the hidden ware since it's the premise of their business. They utilize the prospects market to deal with their openness to the gamble of cost changes. However, not every person in the futures market needs to trade an item later on. These individuals are prospects financial backers or examiners, who look to bring in cash off of cost changes in the actual agreement. Assuming the cost of fly fuel rises, the prospects contract itself turns out to be more important and the proprietor of that agreement could sell it for additional in the fates market. These kinds of brokers can trade the prospects contract, without really any aim of taking conveyance of the basic item. They're simply in the market to bet on cost developments. With theorists, financial backers, hedgers and others trading day to day, there is a vivacious and moderately fluid market for these agreements.